Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
If you look at the dashboard of your car right now, or maybe the casing of your laptop, or even just the sterile packaging that's keeping your lunch fresh, you probably just think you're looking at plastic.
Yeah, it's just, everyday stuff. We take the physical world completely for granted.
Right, exactly. But what you are actually looking at is, in a way, frozen natural gas. You're looking at this invisible, highly engineered chemistry that's been shaped by massive industrial processes, global trade routes, and honestly, incredibly volatile geopolitics.
We just see the final consumer product. We completely ignore the multi-billion-dollar supply chains that are literally pulling raw hydrocarbons out of the earth to make the building blocks of modern life.
And it's super easy to ignore, at least until you realize just how much capital flows through those invisible pipes. So, welcome to the deep dive. Today, we're taking you on a really tailored exploration into this massive, unseen engine of the global economy.
Yep, a company called LyondellBasell Industries, usually just known by its stock ticker, LYB.
Right, LYB. And to pull this company apart and see how it actually works, we are relying on a really robust stack of sources today. Our main guide is this fresh, super detailed research report from Compasscope.
Dated August 10th, 2026.
Exactly. And we're pairing that Compasscope research with the actual transcript from LYB's incredibly eventful Q2 2026 earnings call. Because our mission for you today is to basically cut through all the dense financial and chemical jargon.
There's a lot of jargon.
Oh, there's so much. But we're going to extract exactly what you, as an investment enthusiast, need to know. We want you to understand how this chemical behemoth actually makes its money and how global conflicts are playing a surprisingly huge role in their bottom line right now.
I think to evaluate whether a massive industrial operation like this is actually a resilient business, we really have to start with the physical nuts and bolts, like what do they actually manufacture?
Because if you don't understand the chemistry, the financial numbers are just noise.
Right. They won't mean anything at all.
Okay, let's unpack this. I like to think of a company like LYB as this massive global master baker. Only they don't just bake the bread, which in our case means the finished polymers for packaging or whatever.
Yeah.
They actually own the mills that grind the highly specialized flour. And on top of that, they even license out their secret yeast recipe to rival bakeries.
The flour milling is actually a highly accurate way to visualize their first major line of business. They officially call it Olefins and Polyolefins, or O&P for short.
O&P.
And this segment is so massive, they actually split it geographically.
Yeah.
So you have the Americas on one side, and then a combined Europe, Asia, and international segment, which they just call EAI.
Wait, so what exactly is happening inside an O&P facility? Like, physically, what are they doing?
They're doing something called cracking.
Cracking.
Yeah, so they take raw liquid hydrocarbons, primarily ethane, which comes from natural gas, or naphtha, which comes from crude oil, and they feed these raw materials into giant furnaces called steam crackers.
That sounds intense.
It is. By applying intense heat and pressure, they literally crack the molecular bonds of those hydrocarbons apart. They restructure them into basic chemical building blocks, like ethylene and propylene.
Okay, so that's the raw flour in our bakery analogy.
That is the raw flour, exactly. But, you can't build a car dashboard out of a gas like ethylene.
Right.
So in that same massive industrial complex, they feed those basic building blocks into reactor vessels to link the molecules back together into long chains. That process creates polyethylene and polypropylene.
Which are the actual physical plastic pellets, right? The stuff used in everything from medical IV bags to industrial shrink wrap.
Spot on, and that is just their first business line.
Man. And the second one seems, well, a lot more specialized. It's called intermediates and derivatives, or I&D. So what separates this from the basic plastic pellets we just talked about?
Well, the I&D segment is where the chemistry gets much more targeted. Instead of bulk plastics, they are producing complex chemicals like propylene oxide. But the real star of the I&D segment is this category called oxyfuels. Specifically, chemicals with these long acronyms like MTBE and ETBE.
Okay, stop right there, because if I'm tracking a company, a bowl of alphabet soup really doesn't help me. What are MTCE and ETBE? Like, mechanically speaking, why is LYB making them?
Fair question. They are high-octane gasoline blending components.
Oh, like for fuel.
Exactly. When you pump premium gas into your car, it isn't just raw fuel straight from a refinery. It contains additives called oxygenates. Mechanically, these chemicals add oxygen to the fuel mixture, which helps the gasoline burn much more completely inside your engine.
Okay, so that prevents engine knocking.
Right, and it drastically reduces the amount of smog and unburned carbon that blows out of your tailpipe.
Oh, wow. So as global environmental standards for vehicle emissions get stricter, refiners are basically forced to buy more of these specific oxyfuels to blend into their gasoline just to make it legal to sell.
That is the exact dynamic. It is a highly lucrative, regulation-driven market for them.
Makes sense.
And just moving down their portfolio briefly, they also have an Advanced Polymer Solutions segment, or APS. Think of this as the boutique bakery.
So not bulk plastic wrap anymore?
No, they're compounding very specific, highly engineered specialty plastics. Stuff designed to, say, absorb impact in a car bumper or resist high heat inside consumer electronics.
Got it. And going back to the baker analogy from earlier, there's also their technology and catalysts segment. They literally license out their proprietary chemical process recipes to other chemical companies, right?
Right, and then they turn around and sell those same competitors the specialized catalysts. Basically, the chemical triggers required to make those recipes actually work.
That is a wild business model.
It is. And we also need to factor in their newest division, which is circular and low-carbon solutions.
Oh, the recycling stuff?
Yeah, they are heavily investing in mechanical and chemical recycling. The centerpiece of this is a massive upcoming facility in Wesseling, Germany, which they call MoReTec 1.
Okay, so all of these segments are super interesting on their own, but I guess my question is, why does a single company need to do all of it? Like, why not just specialize in one thing?
Well, integration is the entire secret to LYB's profit margins. Because they manufacture their own basic olefins, the flour, they aren't forced to buy them on the open market when prices randomly spike.
Ah, I see.
They control the raw materials, they control the intermediate chemicals, and they control the final polymers. So this internal self-feeding supply chain acts as a buffer. It protects their profit margins across the entire process, basically regardless of what third-party commodity prices are doing out in the wild.
Okay, so they have built this incredibly integrated, self-supplying chemical empire, but they obviously aren't the only ones doing this.
No.
They're competing against absolute titans in the industry. We're talking Dow, ExxonMobil, Chevron Phillips. So the natural question you have to ask when looking at this sector is, how does LyondellBasell survive in a market against giants who have infinitely deeper pockets? What is their actual competitive moat?
It's a great question. Their primary competitive moat really comes down to geography and geology.
Geography.
Yeah, specifically U.S. natural gas. About 70% of LYB's ethylene and polyethylene production capacity is located right here in North America. And those specific plants are engineered to run on ethane and natural gas liquids.
Why does it matter so much? Are their competitors using something else?
They are. If you look at chemical plants in Europe or Asia, they generally don't have abundant local natural gas. So they're forced to run their crackers on naphtha, which is a derivative of crude oil.
Oh, and crude oil is way more expensive.
Exactly. Structurally, thanks to the massive shale boom, U.S. natural gas is incredibly cheap compared to the global price of crude oil. Because LYB's largest assets use cheap American gas instead of expensive global oil, they sit at the absolute lowest end of the global cost curve.
And they are leaning into that hard. The Compass Scope report highlights that LYB is aggressively abandoning their high-cost European commodity assets.
Yeah, they are not messing around there.
No. They recently divested 4 O&P assets in Europe, and they're outright closing a major site in Brindisi, Italy, just to focus their capital on their geographically advantaged U.S. footprint.
It's a ruthless, but honestly necessary strategy. They're retreating from the battlefields, where expensive naphtha puts them at a disadvantage, and they're doubling down entirely on the high ground of cheap U.S. gas.
Okay, but let me push back on that for a second, because if you look at their U.S. peers giants like Dow or Exxon, they have that exact same U.S. natural gas advantage, right?
That's true.
They are pulling from the exact same shale fields in Texas and Louisiana. Plus, Exxon has the massive safety net of billions in upstream oil cash. Dow has a significantly wider product portfolio.
Yeah.
So if everyone in your immediate neighborhood has the exact same cost advantage you do, isn't LYB's competitive moat actually just a shallow puddle?
It's a really good point, and the Compass Scope analysis tackles this directly. It's a vital distinction. Compared to an Exxon or a Dow, LYB's overall advantage is indeed narrow. They do not have the same massive scale or that upstream oil safety net. But while their moat is narrow, what's fascinating here is that it is incredibly deep in very specific, highly lucrative niches.
Dip in what way? Give me the mechanics of that. Like, how does that actually work?
Let's look back at that intermediates and derivatives segment, specifically the propylene oxide and oxyfuels we discussed earlier.
Your gasoline additives.
Right. Now, most of the world produces propylene oxide using an older, highly energy-intensive process, and it yields a lot of waste. But LYB uses a proprietary technology known as the PO/TBA process.
And TBA stands for what?
Tertiary butyl alcohol.
Oh.
But the true brilliance of this process is co-production.
Meaning they make two things at once.
Exactly. When LYB runs this specific chemical reaction, they don't just get propylene oxide. The reaction simultaneously produces TBA as a co-product. Then they take that TBA and easily convert it into those high-margin oxyfuels, the MTBE and ETBE blending components.
Wow. So instead of running two separate, really expensive factories to make two different products, they have one highly efficient reaction loop that just spits out two incredibly valuable chemicals at once.
Precisely. And here is the kicker. Only about 15% of total global capacity has the engineering to use this specific co-production process.
Oh, wow.
Yeah. Because it is so efficient and yields two premium products, it puts LYB at the absolute lowest cost position globally for oxyfuels. So no, they cannot outspend Exxon across every product line. But in this specific high-demand corner of the market, LYB is virtually untouchable on cost.
That makes a lot of sense. They are basically dominating a very specific, very profitable corner of the sandbox. But if they can't simply outspend the super majors to build brand new $10 billion chemical complexes from scratch, how do they actually grow? Like, how do they expand that narrow moat without taking on crippling amounts of debt?
Their official corporate strategy is branded as grow and upgrade to core.
Catchy.
Right. But the core philosophy is what financial analysts refer to as CapEx-like growth.
Meaning low capital expenditure.
Exactly. They are purposely avoiding massive, highly leveraged greenfield projects, meaning they aren't buying empty fields and building entirely new mega complexes.
So instead of taking out a massive loan to buy a brand new sports car, they are just obsessively tuning the engine of the sports car they already own to squeeze out like an extra 10 horsepower.
That is a very accurate comparison. The industry term for it is debottlenecking.
Debottlenecking, okay.
Yeah, so they analyze an existing operating chemical plant, they find the specific pump or heat exchanger or pipeline that is limiting the total output, and they upgrade just that one specific piece of hardware. Mechanically, this allows them to squeeze significantly more volume and efficiency out of the plant for a fraction of the cost of building a new one.
Makes sense. Though they are spending some major capital over in Europe, we mentioned the MoReTec one advanced recycling facility they're building in Germany, which I think is expected to come online in late 2027.
Right.
If they are fleeing Europe because of high commodity costs, why build a brand new recycling plant there?
Because it is a highly calculated bet on regulatory-driven demand. The European Union is aggressively mandating that consumer packaging must contain specific percentages of recycled plastic.
Ah, first demand.
Exactly. Because of those strict laws, major consumer brands are essentially forced to pay a massive premium for verified circular plastics. LYB isn't building a basic commodity plant in Germany. They're building a specialized facility to capture that specific regulatory premium.
All right, I understand the strategy. It's smart. But let's talk about the reality of tuning that sports car engine. Pushing an existing plant to run at absolute maximum capacity sounds incredibly efficient on a spreadsheet.
Sure does.
But what happens when a critical high-pressure pipe snaps under all that stress? I mean, that brings us to execution risk, doesn't it?
It absolutely does. And the operational risk here is profound, primarily because of asset concentration. LYB relies on a handful of massive, highly integrated complexes along the U.S. Gulf Coast. When they run smoothly, the cash flow is just tremendous. But because everything is so interconnected, a single mechanical failure doesn't just stop one product. It cascades through the entire complex.
And we literally just saw this happen. The Q2 2026 earnings transcript spends a lot of time detailing a major unplanned operational outage at their Bayport facility in Houston.
It was a huge deal.
Yeah, that one outage at one single complex cost them an estimated $250 million in EBITDA in a single quarter.
Right. And for anyone keeping track of the financial metrics, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Essentially the raw cash a business generates from its core operations before accountants factor in all the financing costs.
Exactly. So losing $250 million of that core cash flow in just 3 months from one broken asset perfectly illustrates their extreme sensitivity to reliability issues.
And you really have to view that operational risk through the lens of their financial constraints. The Compass Scope report classifies LYB's balance sheet as weak. Their net debt to EBITDA ratio sits at 2.6x.
To put that 2.6x ratio into plain terms, it means their total debt is 2.6 times larger than the raw cash they generate in a whole year.
Wow.
Right. If a diversified oil major has a chemical plant go down for a quarter, they barely feel it because their upstream oil wells are still pumping cash. LYB does not have that cushion. Their debt load means they absolutely need those chemical plants running flawlessly.
Which makes their recent corporate restructuring sound incredibly risky to me. To hit their cost-cutting targets and improve their balance sheet, they've reduced their total headcount by 17%.
Yeah, that's 3,400 employees gone since the beginning of last year.
That's massive. And even more concerning, they slashed their management layers by a staggering 30%.
Now, management defends this by arguing it improves decision-making speed and drastically lowers their fixed costs.
I mean, I'm sure it lowers costs, but I have to push back here. Is there a point where trimming the fat actually starts severing vital arteries? Like, if you eliminate 30% of your management and oversight layers, who is left watching the pressure dials on these highly complex, multi-billion-dollar, highly combustible chemical plants?
It is a completely valid concern, and honestly, the Compass Scope analysts flag this exact tension. Running a steam cracker at 95% capacity requires a rigorous safety culture and intense operational discipline.
Yeah.
Achieving that while simultaneously executing a massive, rapid downsizing is a dangerous high-wire act. You simply cannot afford process lapses when the hardware is running that hot.
So to see if these risks are hypothetical worries or if they are actually playing out in real time, we have to look at the numbers from their Q2 2026 earnings call. And here's where it gets really interesting.
Oh, yeah.
Because despite that massive $250 million loss from the Bayport outage, Q2 was an absolute blowout quarter for LYB.
It truly was. They achieved a 23% total EBITDA margin for the entire company. And in their O&P Americas segment, the flour milling operation we discussed, excluding special items, they hit an incredible 36% profit margin.
That's huge.
They were running those U.S. crackers at 95% of their theoretical maximum capacity.
Okay, explain the mechanics of that. How does a company pull off record-breaking margins while one of their crown jewel facilities is essentially offline and broken?
The answer is macro geopolitics, specifically the ongoing conflict in the Middle East.
And just a quick note for you listening, we are looking at this conflict strictly through the lens of economic and supply chain impacts, exactly as it was modeled in the financial source materials.
Right. So the reality of that geopolitical crisis was a massive sudden supply shock. According to LYB's internal estimates shared on the call, roughly 6 million tons of polyethylene capacity in the Middle East sustained damage or logistical paralysis.
6 million tons?
Yeah, that represents 20 to 25% of the entire Middle East supply, entirely removed from the global market until at least 2027.
So overnight, a massive chunk of their cheapest global competition just vanished.
Exactly. This instantly tightened the global market. Supply plummeted while demand remained steady, which sent global plastic prices and therefore LYB's margins on their American gas-powered plastics through the roof.
The ripple effects of this were just staggering. Because of the conflict, commercial shipping was severely disrupted. Asian freight rates spiked to the point where it essentially closed the arbitrage window from Asia to Europe.
Meaning, it became way too wildly expensive to ship cheap plastic from Asia to European buyers.
But the most fascinating structural shift was China's reaction. This was the true shocker of the Q2 earnings call.
Definitely. Normally, China is a massive importer of these chemical building blocks. But to adapt to the Middle East supply shock and the skyrocketing prices, China completely flipped its strategy. They fired up their own domestic coal-to-olefins plants.
We really need to pause and explain why that is so remarkable. A coal-to-olefins, or CTO plant, is an absolute brute force method of making plastic.
It really is.
Instead of using natural gas or crude oil, they literally take solid coal, gasify it under extreme heat, and chemically restructure the carbon molecules into plastics. It requires massive amounts of energy and water.
It is traditionally the most expensive, highest-cost way to make plastic on the planet. Under normal market conditions, those CTO plants are deeply unprofitable. But China fired them up anyway, accepting the high costs, simply because it decoupled their supply chain from Middle Eastern oil volatility.
And they didn't just fire them up for domestic use. China actually started exporting those plastics to Southeast Asia to capture the artificially high regional prices. And while doing this, China drew down their own domestic polyethylene inventories by a massive 30%.
They literally drained their national stockpiles to flood the regional market.
Yeah.
It is a staggering demonstration of how quickly global trade flows can rewire themselves in response to a localized conflict.
Insane.
But, we also have to give LYB management credit for their operational agility during this chaos. Remember that Bayport outage that cost them $250 million?
Right, the broken asset.
So to cover that massive shortfall and capture these elevated global prices, LYB engineers took another one of their assets, the Channelview POSM plant.
POSM standing for propylene oxide styrene monomer.
Right, which is another complex co-production process. They pushed that Channelview plant to run at 112% of its benchmark operating rate.
That is incredible engineering. They essentially willed free capacity out of an existing hardware setup just by tuning the system perfectly. But pushing a plant to 112% sounds like running a marathon at a dead sprint. Those margins can't possibly be permanent.
They aren't. And management was very clear to ground expectations for the future. On the earnings call, they warned analysts that Q3 is going to look radically different. They are deliberately slowing their U.S. operations down.
Wait, why?
They are targeting just an 85% operating rate for the O&P Americas segment.
Why slow down when prices are high?
Because they have a massive planned turnaround at their Clinton facility. A turnaround isn't just closing for the weekend to clean up. It is a highly choreographed 70-day maintenance project where thousands of specialized contractors essentially take the chemical plant apart, inspect every pipe and reactor, and rebuild it.
Oh, wow.
Yeah, they have to execute this maintenance to prevent catastrophic failures, but it means intentionally taking highly profitable capacity offline.
Okay, so Q2 was a wild, highly profitable ride driven by external macro shocks and incredible plant engineering. If you are tracking this, trying to understand the pulse of the global industrial economy over the next few quarters, what specific dials on the dashboard should you be staring at? What are the key indicators for LYB's future?
Well, the absolute most critical factor is the oil to gas price spread.
Right.
As we established, LYB's entire competitive superpower relies entirely on U.S. natural gas remaining cheap and abundant, while global crude oil remains relatively expensive. If a massive freeze in Texas causes U.S. natural gas prices to spike, or if a global recession causes crude oil prices to collapse, LYB's structural cost advantage vanishes almost overnight.
So keep a very close eye on the price of Henry Hub natural gas compared to Brent crude oil. What's the second indicator?
China's next move. We noted that China drained 30% of its plastics inventory to capitalize on the Q2 supply shock.
Right.
Financial markets fully expect China will have to start importing heavily again soon to rebuild those depleted national stockpiles. If China re-enters the global market buying aggressively, that surge in demand could further elevate LYB's profit margins.
Got it. You also absolutely have to watch asset reliability. As we debated earlier, they are operating with a leaner, significantly reduced workforce now. They simply cannot afford another catastrophic Bayport incident.
No, they can't. When your strategy relies on squeezing maximum efficiency out of highly concentrated assets, execution has to be flawless.
And finally, you cannot ignore geopolitics. The ongoing situation in the Middle East, the security of the Strait of Hormuz, the viability of the Red Sea shipping lanes. Any further disruptions or escalations there will immediately fracture global supply chains and, by extension, directly impact LYB's pricing power.
If we take a step back and connect all of this to the bigger picture, LYB is basically a masterclass in global energy arbitrage.
Yeah.
They are taking a cheap, localized advantage, abundant U.S. natural gas, and chemically transforming it into premium, globally demanded physical products. As long as the macro environment holds up and they can run their complex plants without blowing them up, the business model generates astonishing amounts of cash.
It really is wild to think about. We started this deep dive looking at the basic invisible chemistry of everyday plastics. We traced how a company uses a laser-focused, highly integrated, CapEx-light strategy to dominate very specific niches. And we saw how the unpredictable, violent swings of global geopolitics are directly funding their bottom line right now.
It is a stark reminder that the physical economy is deeply and inextricably interconnected. A logistical disruption halfway across the world in the Middle East literally dictates the day-to-day profit margins of a cracking furnace sitting in Texas.
It really does. But I want to leave you with a final provocative thought, something for you to mull over that wasn't explicitly resolved in the Compasscope report or the earnings call.
Oh, interesting.
We spent a lot of time today talking about their highly profitable oxyfuels business, right?
Right.
The MTBE and ETBE blending components that make global gasoline burn cleaner. It is their deepest competitive moat and a massive cash cow right now.
It is the absolute cornerstone of their specialized chemical profits.
Exactly. But as the world inevitably transitions toward electric vehicles over the next few decades, global demand for combustible gasoline will eventually peak and begin a structural decline. So what happens to that incredibly advantaged cash cow? Does a proprietary high-margin core strength today slowly become a stranded, obsolete asset tomorrow? How does a chemical giant gracefully pivot away from the very thing keeping its margins afloat?
That is the multi-billion-dollar existential question for this entire industry over the next decade.
Something to keep in mind the next time you check the plastic dashboard of your car and realize you are actually touching a frozen web of chemistry, natural gas, and immense geopolitical leverage. Thank you for joining us for this deep dive. Keep asking hard questions, keep looking past the surface of the objects around you, and we'll see you next time as we explore the fascinating invisible layers of the modern economy.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.